Okay, in this video we're going to talk about dividend policy. And as a continuation of discussions about leverage and gathering money for companies to expand or purchase other companies, dividend policy from a corporate perspective is really a source of financing, or at least it affects the source of financing. And that source of financing is an internally generated capital, which is retained earnings. So if we pay out more dividends, we have less retained earnings, which means we have reduced a source of financing for the company. In other words, we're paying out profits instead of using profits for expansion. So the term payout is fairly obvious, I think. We need to distribute money to shareholders. How can we do that? There's really two ways we can get cash distributed to shareholders. We can do that as a dividend, right? And in the end, we'll actually talk about this a little bit later, we can actually repurchase the shares of the company. Now that is more of a long-term capital question than a dividend question, but indeed it is a way of distributing cash to shareholders. So what are the general lessons that we have learned over time about dividends? Rapidly growing companies generally don't pay out cash to shareholders, or if they do, it's very low. Slowing growth or positive cash flow generation, favorable tax conditions can prompt firms to start cash payouts. We actually saw this happen when the government reduced the taxes on dividend income from your ordinary income to, I think it was a maximum of 15%. Many companies at that point started to pay out dividends. Again, cash payouts can either be made, as I mentioned, through dividends or cash repurchases. There can be many reasons for deciding between the two, but share repurchases is turning out to be a fairly popular approach. And if business conditions are weak, firms are more willing to buy back shares than to cut dividends. In fact, in the end, that is really our overall observation about dividends. Companies will rarely reduce dividends because shareholders see that as such a bad sign and signal. So they'll find other ways to change their distribution than actually changing dividends themselves. So as we can see here, earnings are growing, obviously a fairly robust. There was obviously a big dip here in the early 2010. But what we can see is the dividends in general follow fairly closely. There was a little bit of a reduction in overall dividends paid in this very part of the 2010 era, but in general, dividends and earnings seem to flow together. If you look at dividends and repurchases, what you can see is the aggregate dividends are fairly steady. They have steady growth and they're positive. But since certainly 1976, we've seen a very strong growth in repurchases of shares. So again, managers are managing, all right? They're understanding the relationship between changing dividends and buying back shares. And strategically, there are reasons that they may want to alter the mix of shareholders by buying back stock. So a basic idea or an ethical question then is, are the buybacks of a stock really a bargain, right? Again, if you're returning cash, right? If you repurchase the stock, what happens then to the value of the stock? Why would managers want to do this? So one of the concepts at work here is that managers have a good idea of the value of the stock. And if they think the stock is worth more or is selling for a price higher than what they think it's worth, then they'll buy back the stock, saying that the stock price is actually too high. And of course, this could also be a signal to shareholders. If they're buying back lots of stock, maybe it's a signal that management thinks the stock price is too high. And there's even some new research that shows that to push earnings downward before buybacks, right? Sometimes managers make the stock seem undervalued, causing its price to bounce back higher after the buyback. Again, there's evidence that after a buyback, there is some evidence that the stock price actually bounces higher. So is it possible that managers could be manipulating income, pushing the value of the company down, if you will? So they buy back the stock cheap. And then after they buy back the stock cheap, they make an announcement or some information is given to the public that says, oh, the stock's worth a lot more. So now the stock price bounces back up. So is it possible that managers might try to manipulate their value? Or do you believe, they may more likely want to buy back stock to enhance value, right? What do you think managers' motivation is behind this? And I don't have a great answer for this. I think both arguments above can certainly be made for certain companies during certain times. So the cash dividend policy, essentially what happens is that the board of directors decides whether and in what amounts the dividends are going to be paid, right? If they have an established precedent, right, they're usually going to try to follow that precedent. As I mentioned earlier, boards rarely cut dividends unless they believe that something very serious is going to happen, or that their cash generation ability is somehow seriously jeopardized by some kind of an event. So if you kind of look at industrial firms, whether they're increasing, decreasing, or maintaining dividends, I think you can see that the number of companies that ultimately decrease dividends is much lower than the number of those that are increasing dividends. So these companies, this shows that in general, right, those companies that increase dividends are much higher, certainly far higher than those that decrease dividends, and that's even much higher than those firms that ultimately just maintain their dividends. So we know that management makes some choices, and it appears from this graph that in general, over time, there is more of a tendency for companies to increase dividends than to decrease dividends. So how does this actually work? There is a declaration date. The board of directors is going to declare a dividend payable to the holders of record on a certain day and payable on a certain day. So the first two dates we need to know is the declaration date, that's the announcement date, and the payment date. This is when the check is written. Now, who is entitled to a dividend? It's all those people as of the date of record. So it says, if essentially imagine that there's a book. There's a book that has your name in if you're a shareholder. If your name is in the book on this day, you will receive the dividend on this day. But what happens if you buy the stock the day before, or maybe even the day before? It might take time for that information to ultimately get into the book, the date of record book, so that your name will be paid a check. So what happens is there's what's referred to as an ex-dividend date. Typically, this is 2 business days before the date of record. So this is Tuesday, right? So it would be Tuesday. So Monday is a business day. Friday is the ex-dividend date. On this date, the stock price is going to drop by the value of the dividend. So what that means is if you buy the stock here, or if you buy the stock before here, your name will be in the book, you'll get the dividend. But if you buy it in here, You own the stock. As an owner, you're entitled, in quotes, to the stock, but your name won't get into the book in time. So in this case, what happens, you'll pay, in this case, 17 cents cheaper for the share. This person ultimately then that you sold it to is going to still get the dividend. So they'll get their 17 cents at the date of payment. So this is just a mechanism to make sure that the person who actually owns the stock, in quotes, is the person that actually is entitled to the shares, whether or not their name is in the book or not. So for many years, there's been differences in tax consequences. So dividends that you receive are generally taxed at your ordinary tax rate, and those that were repurchase shares were typically at a much lower rate because they were capital gains tax. And now that is different. Currently, capital gains taxes and dividend taxation are identical. Now, there is a distinction between long-term and short-term capital gains. So if a company wanted to repurchase your shares, you should only sell them back shares that have been that you've owned for more than 365 days to avoid a higher level of taxation. There are plans that are referred to as dividend reinvestment plans. There are certain companies, not every company, quite a few though, that will actually offer to reinvest your dividends instead of paying them to you in cash. What this does is it gives you an automatic reinvestment, which is an automatic compounding of your returns. So you can take these shares, you can reinvest them in the company, usually at very little, if quite frankly, most of the time it's at no transaction cost. So what this does, it allows people to grow some wealth, get some compound growth, and then at the same time, there'll be very little a brokerage fee associated with increasing this wealth. So some companies will allow you to, even to make their initial purchases, you don't even have to go through a broker. Sometimes you can just do it right straight through the company. Typically, you can acquire shares at about 5% below the prevailing market price. So you get these stocks cheaper, you get them at a reduced transaction cost or no transaction cost, and it's a great way to build growth. You only need one share in order to participate in one of these. So if you just buy one or two shares, then they will grow. And what will happen though is there has to be some mechanism for what they refer to here as a fractional share, right? Because a company typically won't pay a high enough dividend to buy a whole share of stock if you only owned one share. So let's talk about what happens to the stock price when a company pays a dividend or repurchases shares. In theory, when a stock begins trading ex-dividend, the stock price should fall by exactly the amount of the dividend. In theory, when a company buys back shares at the going market price, the market price of the stock should remain the same. In practice, though, taxes and some other market imperfections may cause the actual change in price and response to one of these payments to deviate from what we expect in theory, right? So if we expect the stock not the price, there is a pretty good chance that there's something in the market that's going to impact the value of the stock, and it may change in a way that we're not expecting. So we want to talk a little bit about payout policy. And we'll start with a very simple version of payout policy. And in a future video, we will incorporate some more theoretical types of ideas. But the financial literature has reported a number of theories, right? This research is at times contradictory, to say the least, right? So sometimes companies will experience things that aren't exactly what you would expect from what a theory would say. So in this question, when we're talking about dividend payout, we're really trying to ask one question. Does a payout policy of a company, or when we change the payout policy of a company, does that have a significant effect on the value of the firm? Now, we have a theory which is referred to as the residual theory of dividends. And this is not a very commonly approached idea of how dividends are paid. However, if you remember in previous videos, we referred to owners as being residual owners. They only get something if something is left over. So this residual theory of dividends distributes dividends, but only if there's money left over to actually distribute. So there will be times when we have excess cash and times when we don't. So how this essentially works is we're going to find out the optimal level of capital expenditures, right? So we're going to find all of those capital projects that have positive net present values, and we will know how much money we need to gather. Using an optimal capital structure, then, we're going to determine how much stock we need of that money. So, for instance, if we say we need $100,000 and we have a 70% equity mix, 70% equity, 30% dividend or debt, then of that 100,000, we're going to need to gather 70,000 in equity. Now, if you think about equity, there's two kinds of equity. There's two kinds of capital that we can gather that we would put a label on and call it common equity. We've talked about the first one here a little bit earlier. Retained earnings is a source of financing. So if of this $70,000 that we need, if we think we're going to have $60,000 in retained earnings next year, then we only need to issue $10 million since we have 70,000. Let me go back. I'm sorry. If we needed 70,000, and let's say we thought we were going to have 100,000, right? Then we would use the 70,000 to buy the asset, and we would have 30,000 left over to give to our shareholders in the form of a dividend. However, if we thought we were only going to have 60,000, we wouldn't have the 70 that we would need, so we would pay 0 dividends, and the rest, all the money would be invested, including the new stock we would issue, would all be invested, put into the equity account, so we could purchase the new assets. So the idea of this residual theory of dividends is that it changes, and that from time to time, depending on your investment opportunities, depending on the economy, depending on sales and the actual cash that you have to pay, all of those things change from quarter to quarter to quarter. So our dividends, according to this theory, could change rapidly and drastically to as low as 0 from time to time. So theoretically, it kind of makes sense with respect to how we think about owners, but from the perspective of an investor, if your company did this and it was trading stock, quite frankly, I don't think anybody would buy the stock because dividends would be so unpredictable.